Welcome to the Money Tips No One Told You podcast. I'm Heather with First Pioneers Federal Credit Union, and I'll be your host. At First Pioneers, we're dedicated to caring for our members' financial needs with heart, and that means providing more than just financial services. It's about empowering you to take control of your financial destiny through knowledge and understanding. This podcast is all about guiding our listeners toward a brighter financial future. So get ready to embark on a journey towards financial well-being, because at First Pioneers, we believe that when our members are financially successful, we all succeed. Stay tuned for a wealth of knowledge and inspiration. Hi everyone, welcome back. We are actually doing this episode just a little bit differently. Recently, we did a lunch and learn on Facebook, and we covered credit and savings tips that were just really important. And it was a lot of really good information. So I wanted to share that here on the podcast. So what you're going to hear today is a recording of that Facebook Live. So we're going to join that in progress, and I hope you guys enjoy it. So my name is Heather. I'm actually the marketing director here at First Pioneers, and with me I have Lawoka, who is our CEO, and I also have Jeff, who is our VP of lending. And I wanted to bring these topics to you guys today because actually I find recently there's several people that, as I'm talking with them, there are credit and savings things in particular that they're just not aware of. And I really didn't realize that that was happening. And it kind of goes a little beyond a lot of the conversations that we typically have around here. One in particular is we're always talking about paying off debt. And any of you guys that especially listen to the podcast, you know that I talk about paying off debt all the time and that it's a good thing. But I'm finding out, I actually found out recently that paying off a loan can actually impact your credit score. Jeff, can you kind of explain a little bit of why that is the case?
So that's actually a very good question, Heather, and it's one that I get asked very often by our members, and it, it's always a possibility. And a lot of times, what that can depend on is it can depend on how limited your credit is. If you're very limited on your credit, it can cause a drop in your score because you don't really have a long established history to sort of balance that out. Another thing that can impact that if you pay off a loan early, or if you pay off a loan in general, I should say, is if it throws your product mix out of balance. And by product mix, I'm talking about having the right mix of revolving accounts like credit cards, installment accounts, such as auto loans, personal loans, things like that, and then also a mortgage account too for a home.
Okay, so it affects your mix, so that your score could take a hit for this, right? It could go down.
It could, it could. I mean, it's usually not something that would be a massive hit, but it is something that could cause a slight dip in your credit score there.
So if it dips, it'll most likely come back up. I mean, how long do you think it would take for that to happen?
So sometimes, I mean, like a lot of times it goes back to how limited you're on your credit and how that affects your product mix on there. If it's not really something that affects two of those two variables or anything like that, it's probably not even going to be something that you notice. If it does, then you probably want to look into which one of those it's affecting you. Like if it's a closed credit card and maybe it got closed for one reason or another. I don't, it could be, a whole variety of reasons. But if it did get closed or something like that, maybe try looking at getting another one to replace that, and then that gives you back that right mix of products, meaning revolving accounts, installment loans, and a mortgage account.
Okay. And I'm going to clarify an installment loan is something like a vehicle, right?
Vehicle loan.
Something that has an ending
Oh,
date of when you pay it off.
correct.
Okay. Um, and we talked about credit cards. This is when that was a big one. I was talking to someone the other day and they said they were so excited because they were paying off a credit card and they could not wait to make that last payment. And then they said, as soon as I pay it off, I'm going to close it. And I looked at her and I said, don't. Can you explain why it is
So
not a great idea to close that account?
sure. So most consumers only have a few credit cards. And so if you close that credit card, then you're going to lower what's referred to as your available credit there. Okay. And particularly if it's one with a larger limit, and then you're only leaving open a few credit cards that have maybe some smaller limits on there, then that right there could have a significant effect on your credit score there. Now that being said, I do get a lot of people that contact me and they may have, 8 or 10 credit cards and they say, okay, I'm just looking to pare it down some. And that right there, there's nothing wrong with that. If you want to maybe pare it down or something like that, that there's really nothing wrong with that because sometimes people just don't want the exposure, it just, that they have a little bit of anxiety on that. And what I would always recommend doing is if you are wanting to pare it down, look at the ones with the smaller limits and also look at the ones that are the newer accounts. You definitely don't want to close your older accounts because that can have a very adverse effect on your credit score. But you also don't want to close the ones that have the larger limits on there. If you maybe have like a few store charge cards that have some three, $500,000 limits versus you may have a Visa card that has a $10,000 limit on that, well, you definitely don't want to close the Visa one. If you are going to close anything, you want to look at closing those smaller ones. And if you've got one that you've had for many years versus one that you just opened last year or something like that, then and if you are looking at paring down your collection of credit cards, you would definitely want to strongly consider the more recently open ones as opposed to the older ones because that can change your what they refer to as your average age of your accounts on there, which accounts for a large chunk of what computes your credit score.
Okay, that's good to know. Um, but if you leave those cards open, and this is also something I just recently learned, if you leave that account open, you don't want to let it stay idle. Like, right? You don't want to just leave it there and not use it. So, what would you recommend, um, or what do they need to do?
That's correct. So
Um,
most everybody has their one or two cards that they use for a lot of their day-to-day so forth, and so forth. And then, you may have one, like, case in point, I have one that I've had since I was 18 years old. I never use it because I use the one that I get the rewards on. But I don't want to close it because I've had it for so many years now. And so what I always recommend is try using it at least once a year. Even if you just go over there and buy something for like $5, $10 or something like that, go over there and look and see when your statement cuts. Go put a reminder in your phone to go in there and make that payment on it whenever your statement cuts, and that will give you that one transaction per year that you need to keep it active. And I always say a year just because I mean you don't want it to get too far out there. Most creditors will look at anywhere from 1 to 3 years of inactivity before they would close any kind of credit card or anything like that. It's very rare that somebody's going to close one after just a year of inactivity. But if it's one that you've had for a really long time, you kind of don't want to take that chance either.
okay. And is it also possible if you let it sit for too long, they may reduce your credit limit, right?
Yeah, and that's always another possibility because and the whole idea behind closing the credit card or reducing the limit on it or anything like that is if you don't use it often, you don't think about it, you forget about it, so you have a much higher risk of there being some fraud happening on that card. Somebody could go over there and get that credit card number, they could go and run up a bunch of charges, and then you don't, because you don't see that card every day, because you don't use that card every day, because you're not logging in and checking it on your phone every day, you're not seeing all these cards until a couple of months pass or something like that, and then boom, you're hit with all of these, you're hit with these large balances that you try to have to go over there and dispute there. So that it's really a like a fraud deterrent, I guess, is what it is.
Oh, that's a really good point. I wouldn't have thought about it like that either. Um, and one more thing I want to ask you about, and again, I had someone ask me this. Um, let's say you go to a store where they're offering a special where you can purchase, furniture or a computer or whatever it is, and you take advantage of a 0% offer for 3 years or something like that. I did not realize that that actually shows up on your credit in kind of a different way, I think. Can you explain that a little bit, how those really work on your credit?
So a lot of times what they will do is it will open as a revolving account. So basically like as a charge account, just like it would any store charge account. And if it's something that's open with a limit that is the amount that you borrowing or near the amount that you're borrowing, then that right there is going to adversely affect the utilization. And so that, of course, in turn can have an adverse effect on your credit score as well, too. So if you're going to Rooms to Go or something like that, and you're buying $3,500 worth of worth of furniture, and they open you a charge account with a $4,000 limit on it, then you have that thing mostly used up. And if you have a couple of other credit cards that you might be at 25, 30, 35% utilization, and then you go over there and you have this other one that's added to your mix that's mostly maxed out, then of course that can have a significant impact on you if you're maybe looking to buy another car, if you're looking to get a mortgage to buy or refinance your home or something like that. So it's always something that you want to be careful of whenever you're taking advantage of those kind of situations. Another thing that you want to be aware of, and I actually did not know this until years ago, whenever this happened to my mother-in-law, is that the a lot of the store charge accounts now, let me back up a second and just say some of the issuers have gotten away from that, and they have gone through major issuers now, but you still have some of the ones that are direct issuers of their own store charge accounts. And with those, in the event that the card is compromised or for whatever reason, you don't have the protections in place on those that you would if you had a major credit card like a Visa, MasterCard, or one of those like that. So you're basically assuming all liability. In my mother-in-law's case, it was a stage card, and my wife's stepdad lost his wallet. Somebody took the card, went to stage, ran up 700 something dollars worth of merchandise. And when they called about it, they said, "I'm sorry, there's nothing we can do." And so they were stuck paying it. And that's basically what they explained to them at the time, was that because it's not a Visa or a MasterCard issued by any major issue or anything like that, that there's nothing that they can do, because you don't have the protections in place that you do when you're looking at using a major credit card there.
Wow, that is great information. That is not something I ever would have thought of either. That's a lot of great information. Thank you, Jeff. And I, I just want to, reiterate that these are things to keep in mind as you're taking out loans, or you're doing things at places like that where you're taking advantage of those offers. And if you are planning on taking out any big loans, maybe you need to buy a car or a home or something like that. Just kind of keep these things in mind as you're looking at your credit score or your credit report, so that you kind of understand what you're seeing on there and how it's affecting your score. Because there may be some things you can adjust or do, especially before you go make that big purchase. Um, Okay, now I want to jump to savings for just a minute. I think there are people that often don't understand the choices that they have. And when it comes to savings accounts, and that they can have multiple accounts. And I feel like sometimes it's just hard to choose kind of what account is going to be best for you. Um, so, Lawoka, you think you can talk a little bit about kind of the different account types and maybe some of the pros and cons with the different accounts that are out there?
Sure. So we have here we have a regular savings account, which everybody knows how it works. You get unlimited withdrawals from it. You can deposit as much as you want. The interest rate does tend to be lower than other savings products. Um, and then then you have your specialty savings accounts like your Christmas club or your vacation club. Those you can make regular deposits into them, but you're limited to your withdrawals. Uh, you can withdraw from them, but there's usually a fee based on it. And then the money is transferred over into your savings account, your regular savings account at the designated time. So it's like Christmas clubs, those are transferred into your savings account November 1st. Uh, Again, the interest on those accounts are the same as the regular savings account. It's a lower interest rate, but it's the money safe and secure. Then you have the money market account, which is generally a little bit higher interest rate, not the highest interest rate you can get, a little bit higher. You can deposit as much as you want into that. You are limited to 2 withdrawals a month. And then if you need more withdrawals than that, within the month, it's $10. Um, you do need to have a minimum deposit in those type of accounts to earn the higher interest rate, but it's low. On the money market, it's $500. So anything below $500, you owe the regular, you earn the regular savings account rate. And then we have our youth savings clubs that we call Explorer Club, and it's a high yield savings account. And we want to encourage our young children to save their allowance or their birthday money or whatever they have. So it earns right now. It's earning 5.5% for the first $3,000. Most children do not have more than $3,000. We're not making this their college fund. It's just their savings account. So the first $3,000 earns 5.5%, and then once it reaches higher than 3,000, the amount over the 3,000 goes back to the regular savings amount. It's great. The kids love it. They come in every time they make an in-person deposit. They get to either get a token to spin the little gumball machine, or they can spin the wheel. So our children love that product. And then you have our CDs and our IRAs. So our CDs earn a higher interest rate. There's a minimum of $1,000 to open it, and we have terms between 6 months and 5 years. So you pick what term you think best fits your situation. And then of course, the interest rates are higher, and there's an early withdrawal penalty if you do need your money earlier. And those are set based on the term. So I can say, if you have a 6-month CD, the penalty would be 30 days of interest. You don't lose your principal. You never lose your principal in a CD or an IRA here, because our IRAs are based off of our CDs. So they're safe and secure. You never lose your principal from our credit. We do not invest in the stock market or CDs or IRAs. So the money is safe and secure.
Okay. Um, so it really seems like when you're looking at a savings account, you really just need to consider what is you're trying to do with that money. What's your goal? What are you trying to save for? And then maybe from there you can choose what account is going to be the best one to put that money in, right?
Yeah.
Um, so can you talk a little bit more about CDs? I feel like people they don't always really understand that a CD can be a good option. Um, and also I think they get a little tripped up with the terms a little bit. Can you talk about that a little more with the CDs?
Or what I see here a lot is people have money sitting in a savings account, which is great. If you need the money, say within 6 months, you need your $20,000 you might have saved, or even, $2,000. If you need that money within 6 months, then yes, put it in a savings account. You're earning less money. But if you don't need it, say you don't need that money until next summer, then you want to put that in a CD, put it in a 6 month or a year CD. You're going to earn more interest if you're not going to need the money. I see a lot of people just having money sit in their savings account instead of making their money work for them, basically earn them more money. So that's one of the things that you really need to do. If you don't need that money, then put it, I call it lock it up, but put it in the CD for that term. And then you're earning more money, you're making more money for yourself.
Right. And tell me again what the minimum deposit is for a CD.
The minimum deposit is $1,000 and the minimum term is 6 months.
Okay. So I think there's times when people feel like that it's out of reach, that they think they need more to deposit in a CD, but it's actually, not a huge amount. And if you've got that, like you said, that's a better way to grow that money than just in a regular savings account.
Mm.
Um, so let's talk for just a minute about the terms. Because I know a lot of times with a CD, depending on the term and the rates vary from one term to another. It may be a different rate. So, um, h- how do you sort of understand that and know what to do or how to make a choice of which one to choose, other than when you need the money?
So that's one of the hardest things is to predict interest rates. I mean, the future is definitely uncertain. We have no idea. We can look at what economists say. Right now, the economists are saying that the Federal Reserve is going to lower the interest rate. If you looked at the beginning of the year, they said that they were going to lower it 3 times before the end of the year. Now they're saying 1 time. I mean, the future is uncertain, but we can only base our own financial decisions off of, the experts. So right now, they still consider this, even though they haven't lowered the rates, they're expecting the rates to lower. So they're calling this a declining rate environment. That means they're expecting the rates to go down over time. So what I would do is I would put my money long term. So 5 years at 4% versus 6 months at 4.5%, because what is interest rate going to be in 6 months? We don't know, but we do expect it to be lower. So I would lock it up for 4% for 5 years, because in 5 years, I can guarantee you, well, I can't guarantee you, but I can tell you that most likely the interest rate is not going to be 4%. It's going to be much lower. Now, when the economists are expecting the rates to go up, so a rising rate environment, you want to do the opposite. You want to lock up your money for shorter amounts of time, because say right now it's 4.5%, but then in 6 months it might be 5%. That's in the rising rate environment. We don't have that right now. We did have that 2 years ago when things were, going up really fast. They're not coming down as quickly as they went up for sure. But that's what I would do. It's look long term. A lot of people are looking at rate right now and they're like, I'm going for the higher interest rate. But if you look at your 6 month interest rate or versus your 5 year interest rate, even though the 5 year interest rate is lower right now, you're going to end up earning more money. So that's what I would do. That's my recommendation to everyone that I talk to. Again, you can only base it off of you, what you need.
Yeah, because I know, like you said, the amount of time that you may have before you need the money obviously is gonna play a big, role in that, but if it's money that you're just sitting on, you don't really need it, or maybe it's something that it is an investment for you that you're looking at it as long term, hey, you're absolutely gonna make more money if you just keep it in a long term.
One of the things that just happened is my mom sold her house and she moved into a smaller house. So she had extra money, but she's going to have to pay taxes on that capital gain, but she's not going to have to pay taxes on that until next April. So we fully calculated what her taxes were going to be, and we put that money in a CD. So she, for it, not a year because she didn't have a year left before she has to pay taxes. So we put it in for 6 months. So in 6 months, she's going to earn a little extra interest, and she has that money saved for all her taxes.
Yeah, it's a great idea. And there's so many options you could use this for that would help you grow that money. Like you said, it's money that she's not going to need for a little bit. So, why not earn a little extra interest on that? And like you said, I think it's evident that the interest rates are going to start coming down at some point. I feel like we're kind of at record highs right now. But and like you said, we can't predict the future, but we can listen to the economist and kind of pay attention to what they're saying and what the options or what we feel like is going to happen in the future. So yeah, I think this is just great information. I just feel like so many people they just often get tripped up. I've said to people, "Oh, you could open an additional account, or you could open this kind of account or that kind of account," and they honestly just didn't know that you could have multiple and that was okay and that these were options for them. So I'm glad we were able to explain that to all of them. So I don't have anything else unless you guys do. We can start wrapping up. And I also want to make sure that I say this. We are always here available at both First Pioneers branches. We have our branch in Lafayette. And we also have our branch in New Iberia. You're welcome to come by and speak with someone if that's what you're more comfortable doing, and we can help explain these things to you. You can also check us out online, firstpioneers.com. It's really easy to find. A lot of this information is there as well, so you can, take your time and kind of go over that information at your leisure. And we also have a live chat on our website, so you can actually chat with an attendant or a customer member services rep there if you have a question. And that's how you're more comfortable doing it. So we have several ways that you can find us. So feel free to reach out if you have any questions for us, and we will do our best to help you walk through whatever issue that you might be having at the time. So if you guys don't have anything else, then we will wrap it up, and we'll thank everyone for watching, and we will see you guys next time. That wraps up another episode of Money Tips No One Told You. We hope you enjoyed the insights and tips shared today. If you have any questions, thoughts, or topics you'd like us to cover in future episodes, feel free to reach out. If you found value in today's episode, don't forget to subscribe, rate, and leave a review. Your feedback helps us tailor future content to better serve you. There are several ways you can find us if you need further information or need to speak with a financial counselor. Visit us in person in Lafayette or New Iberia, Louisiana, or at firstpioneers.com to find out how to become a member of our family and find other financial information. Also, be sure and check out the show notes for important links and important information. Your financial journey is important to us, and we're here to support you every step of the way. We hope you have a great day, and we'll see you next time.